Hey there, I'm Seb Frey, the Realtor, and if you're thinking about buying a house, maybe for the first time, you probably have some questions about how mortgages work, what the different options are, and how different rates and points and fees and all that, how that all comes together. If that's you, then you need to stick around and watch this video. All right, well, before I get into all that, I'm going to have to ask you to please, Bing, subscribe to my YouTube channel, and don't forget to click the little bell icon to make sure that you get a notification every time I put up a fun, new, interesting, and very informative video, kind of like this one. I had another meeting with Janice Smith of Guild Mortgage, and she went over her mortgage coach tool with me. It's a fantastic tool that she uses with her borrowers to show them a lot of different options they have when it comes to getting a mortgage, right? There's obviously 30-year fixed mortgage, ARM mortgage, interest-only mortgage, 15-year mortgage. I mean, there are many different options. And then your payment obviously is going to vary based on, your interest rate, but your interest rate can change based on the number of points you pay and how much anyway are you going to need to pay these points and for closing costs and all that stuff. And so, there's a lot of choices that you actually have as a borrower, and Mortgage Coach really helps Janice coach her clients on, their different mortgage options and what makes most sense for them. So without further ado, let's get into the video.
All right. Hey, everybody. It's Seb Frey here again with Janice Smith with Guild Mortgage. And Janice and I got on a Zoom meeting just like this one last week, and we talked about the cash pass program that they have, and lock and shop and their bridge loans. And we got to talking about this other cool tool that Janice and Guild Mortgage have, which is Mortgage Coach. And I think it's a tool that helps borrowers discover what their mortgage options are. And I think a lot of people who haven't taken out a mortgage recently, or perhaps who have never taken out a mortgage, really don't know how all this sort of comes together. So now we're going to go deep in the sausage factory, and Janice is going to show us how people basically figure out what kind of mortgage would work best for them. So Janice, thank you for showing up again here today. I appreciate that, and I can't wait to have you take us through Mortgage Coach.
Great. Thank you, Seb. I appreciate you having me back. And it's fun to educate everybody on the programs and tools that are available to make this process smooth for them. So I'm going to share my screen and I'll go over really quick. Mortgage Coach is a program that we use. I can send you up to 4 scenarios, but then I can also copy and send more scenarios. We start with 3 or 4 as not to make it too confusing or too overwhelming. I go in, first I will have a conversation with the buyers, the prospective buyers, find out what their comfort level is, what they're thinking about purchase wise, what maybe their highest purchase price that they feel comfortable with. I'll show them that, but then I'll back it down maybe by $100,000 to then show them the difference in payments, the difference in closing costs, property taxes, just everything that goes into having a home loan and purchasing a home. Once I've done that, I will email a share link to the clients. They will just click on the share link and they'll be brought here to this page. And it just lets them know that this is the total cost analysis is what we call this. So basically we're taking all the costs that go into your mortgage, down payment and closing costs, and shows you what we're talking about you needing to bring to the closing table in order to get your home. Sometimes when you see it like this right in front of you with everything labeled and added up, you might say, oh, maybe we feel comfortable with a little bit more. I didn't know it was like this. Or maybe, oh, maybe we want to do a little less. So that's why this is wonderful, because as I scroll down here, you'll see you're going to be able to compare them side by side. So you're not flipping back and forth from screen to screen. It's all right in front of you. What I've done here is I've started with 1.35 purchase price. And I'm showing a 5% interest rate and a 5.25% interest rate on the same purchase price. And I'll let you know why I'm doing that in just a bit. The buyers were most comfortable, John and Mary, at a $1.4 million maximum purchase price. So I put that in there. I'm showing that to them at the 5% because I wanted to save space for the 1.35, which is what they were actually going to offer on a home. I wanted to show them an adjustable rate mortgage. I know, don't run scaring out the door about an ARM loan. They're not scary and dangerous. When interest rates go up like they have, a lot of people have reverted back to the adjustable rate mortgage because the interest rate will be a little bit lower. And when we're talking about a higher loan amount, as we are here, over $1 million, you can see a couple $100 savings per month. So for some people, that's worth doing. The rates are higher now than they have been in the last 2 years, but this is cyclical. Rates go up and down. Within 7 years, the odds on rates not dropping or being higher than they are now are very high. And you can go back through the history of mortgage rates. I can even show you that to help comfort people with thinking about or going into an adjustable rate mortgage. But I do like to give them that option because here, as we see, we have gone all the way down to 4.625. The rates have what we call a discount point. So you will pay some points towards lowering your interest rate. My company also does help with a little subsidy to equal out a little, to help you out with that. But I want to show you real quick. If we go up here, I'm jumping a little bit, but I want to show you the difference here, the 5.25, 5, and 4.625, the costs. So we have on our costs, my apology. Sometimes it's hard to maneuver through these and find where the costs can be. Sorry for the delay.
It's okay.
Okay, there we go. So these are the points. I was talking about the discount points. For the 5%, we see here on the 1.35, we have an $8,100 points. And over here, 5% on the 1.4, it's a little bit higher because the loan amount's a little bit higher. So that's what you're paying on that. For the 5.25, the discount points are considerably less. So this is where we start talking about what are you more interested in, having a lower monthly payment. And we look and say, how much lower is the payment at 5 to 5.25? Well, maybe it's only $100. And then we start saying, well, we're looking at, substantially more money that we're putting in. And how long will it take me to recoup this cost? So these are the things that we will go over when we're discussing what you want to do with your purchase interest rate and your points that you may have to pay. So then I want to slide down here and you'll see at the 1.35 on the ARM, you're paying the 8,100, but we're getting that much lower rate of 4.625. So that's just to show you really quick about the points and such. And I'm going to go back to the page.
One second before we get off the points. I think that a lot of people don't understand really what points are. And so I just want to give my take on it. And if I'm correct, let me know if I'm incorrect or whatever I am. So points are also called discount points. And basically by paying a discount point, which is a percentage of your loan amount, not a percentage of the purchase price, you can discount your mortgage rate. So you can pay 0 points and your rate will be higher. Or if you pay more points, your rate will be lower. And you can think of it as basically prepaid interest. So basically you're giving the lender a whole bunch of interest money up front in exchange for lowering the interest rate over the course of the loan. And by lowering your interest rate, so maybe you pay $8,000 for a point right now, But that $8,000 after you pay your mortgage at the lower rate over a period of maybe 4 or 5 years, at that point you will have exceeded the savings, right? So maybe every month you save $100 a month because you bought your rate down. Well, after 84 months, you will then you have recouped the cost of paying that point, and then every month that you hold the loan after that, you're making money.
Correct.
Is that right? Do I have that correct?
That is correct. Yeah. And so people do it for different reasons. Sometimes they do it so that they can qualify. That sometimes is another reason to do that, to get you into an interest rate that gets you qualified. And again, this is more in details that I will go into with people on, does it make sense to buy the rate down? That's something that we talk about. Because when you're purchasing a home, it's good to have money in the bank because you're purchasing a home and you may have to do some things. Maybe you wanted to put new floors in, or maybe something pops up that you have to pay for. So we have to discuss all of these things when we're talking about your mortgage. I like to help counsel you on all of the different options you have, and possibly things that you've really never heard of and didn't know you could do. So that's why being a lender that sits down, has those conversations is beneficial to our buyers.
Okay.
So yeah.
I also want to mention one thing about the ARM. Actually, I had a client close an ARM a couple of weeks ago, and it was the first time I've done an ARM in, I don't know, 15 years. I mean, it's been a really long time since I did an ARM loan, and his is a 10-1 ARM, right? And so that means his rate is going to be fixed for 10 years. But what's the average number of years that somebody actually holds a loan? It's nowhere near 10 years, right?
No,
Isn't it?
Probably 5.
Yeah,
probably
4 to 5 years. So most people are refinancing within 4 to 5 years anyway. So everyone's always worried about, oh, my rate's going to go up, but more than likely you will refinance before you ever hit the end of your interest rate lock with an ARM.
Right. And the other thing too is, if this isn't your forever home, this is, I want to get my foot in the door home, I need to get in here and start building my equity. Well, in 4 to 5 years, you're probably going to have got the equity that you were looking for in order now to move on to the next home. So you're either going to be refinancing, selling and buying up, or, maybe in a different neighborhood, whatever you wanted to do. So like we said before, no mortgage is forever. They're not for 30 years. And before it got to the point where it could adjust, even if the rates on the fixed aren't as low as you wanted to go, we can still refinance you back into another ARM and start that 7 or 10 years all over again at possibly the same rate or even a little lower on the ARM. So it's, again, if we look back at the history of mortgage rates, this is a proven point. Like you said, 4 to 5 years, people want to refinance and change the terms, whether it be into the 30-year or lower the interest rate.
Yeah, or even interest only in some cases.
Yeah, there are some that do that. We don't have interest only for Guild, but I do have a source. If you are interested, I can broker them out.
I got interest only.
There's always a guy. We always can find a guy, right?
Right. So
let's just look real quick here, because this is interesting. Is we have the 5,797 on that 30-year fixed at 5%. When we do 5 1/4, we see we've gone up almost $200. And then when we're at the higher loan amount, because of the higher purchase price at 5%, again, we're going to have a higher payment. But what's really interesting over here is that adjustable rate is $5,500, and it does cost the same as this rate, but you're getting $250 a month in savings for paying the same amount of money. And then over here, if you didn't pay the same, if you only paid the $2,100, I think it was, yes, you are going to be paying more in the $8,100, but look at our savings here. We are we're at quite a bit savings. So we're going to recoup that $8,100 fairly quickly. So that's why we talk, if we can recoup that the money that you paid for the discount points within 24 months, and we're talking about holding on to a loan for another 2 to 3 years after that, you've made the right financial decision, because you now are truly saving that money every month. And so that's a reason why we talk about the adjustable rate. It's also why we use the total cost analysis, because it's just right here in front of you. We can just see everything, and you can see what your property taxes look like. Obviously, a little more expensive home, a little higher on the property taxes. I usually just kind of run the same mortgage hazard insurance. I'm sorry. That's a moving thing depending upon what you need to cover over and above your home. We don't have mortgage insurance because this is 80% loan to value. And then we have our total monthly payment. Now, some people will pay the lender the property tax and hazard insurance in their payment, because they don't want to have to think about property taxes twice a year or paying their homeowner's insurance. They just like to know that it's just being paid. Then you would pay this total amount to the lender. But if you are just going to pay on the mortgage, this is what you would be paying the lender. And then your responsibility is to make sure you have this saved every 6 months for property tax and every 12 months for your insurance. So that is the payment breakdown. And the next thing we want to take a look at, we had looked at our closing costs, and down here we can go into fee detail. Now this brings up what those closing costs are. This will include the lender's fees and the escrow title company and the government fees, as any transfer taxes and recording fees. And it just breaks it all down on who. I have in here the owner's policy, because in case a contract is written, I like my buyers to know what you possibly, the most amount that you could pay. It is in Santa Clara County, usually, as you see here, the seller pays the owner's policy, and the settlement fee a lot of times is split, or the seller will pay. And then the city transfer in San Jose, you'll always pay half of it. And the county transfer fee, the norm is that the seller pays that. So just like to have all of that in here. I don't know why I have a tax reserve in here. I apologize. That was not supposed to be in there. But this just this shows you all of the fees changed. So the best part about this program is, while you're in here looking at it, if you say, I think we want to put 25% down, can we see what that looks like? I can go back into Mortgage Coach. I can make the changes, and you will see them on your screen in front of you, changing right in front of your eyes. So we can have a good conversation. You don't have to wait for me to go back, draw up a whole new plan, send it back out to you. We can have that conversation over the phone, and changes can be made right in front of you.
So they're looking at a web page. You're looking at a web page.
They're looking at this. Yeah.
When you update yours, it updates on their screen as well.
Right. I jump back over here to the engine, and then I can make my changes in the engine. And as I'm making them, they will continue to look at the presentation, and they will see. So if I put 25% down, they're going to see this change, because this is the total cash to close. So obviously 5% more to bring in is going to raise that. And that's another thing that's really nice about this. The other presentations that I can give to people, I can pretty much give a presentation for just about any question people have. Well, interest rates are high. I think I'm going to wait. I can give you a presentation to show you what it costs you to wait, because interest rates might be high, but in this area, the equity continues to rise all the time in this area. So we need to see if you're paying a little higher in the interest rate for 2 years, because that's when we can refinance, because the rates went down. Oh, now I'm ready to buy my home, the rates are where I want them to be. How much equity did you just lose in that home? And did you take yourself out of the ability to even buy a home because prices went up to where you can't qualify? So that's another presentation that I can send to people. I have rent versus own presentations, and I also can do a presentation for current homeowners who want to purchase, sell their home and purchase, and we'll show them their current housing and what their prospective housing is, so they can see if they truly do feel comfortable with making that move.
Okay.
So, yeah.
Well, I have some questions here on this. So you have APR costs, non-APR costs, prepaids, and contributions.
Mhm.
What is all of that stuff in there? What is APR costs?
So certain fees, they are APR, and what that means, it's the cost of you doing the loan. They add a little, they calculate it a little bit different. It has nothing to do with your interest rate. It just shows you basically what you're being charged to do the loan, my costs versus maybe another lender doesn't have the same amount of costs. And so they say, oh, you know, it's cost less for me to do the loan over with this person because they don't have as many APR type costs. That's basically what it is. It just has to do with what the costs are to do the loan.
Is it like an origination fee? Is that what that is? Or what is
no,
that?
no, this, you're not paying this. This is just the part of your fees are APR fees. They have fees that they attach the APR rule to, which talks about the cost of over the lifetime of the loan, what the cost is because of these fees.
And is that in the fee detail? Like if I were to look at fee detail, those APR costs are inside fee detail?
Yeah, let's see right here. It should say APR fee, a funding fee, a tax service fee. Now, if maybe you have another lender that doesn't charge this, or they charge more or less. So you can see what you're paying to each, basically it comes down to what you're paying each lender to do the loan for you. That's pretty much what it is, so that it kind of helps you determine. So this is what they bump the interest rate.
So those are normal loan fees.
Those are all normal loan
underwriting
fees.
fee,
Yes,
you know, like okay, all that stuff. And then the non-APR costs, what are those? What would
so
be
they don't, so appraisal fee, credit
appraisal
report,
fee,
flood
credit
cert,
report,
all of these,
lender's title insurance,
wire, the county type fees.
So these are not those are basically fees that have really nothing to do with the loan. Is that correct? Like city transfer tax,
right?
Right. So okay, those are non-loan costs that are not specifically for the loan.
Recurring and non-recurring costs. So these are technically all non-recurring costs. You will only pay these costs to purchase this home, or if you do a refinance. Recurring costs are interest, property taxes, and homeowners insurance. Those are recurring because you have to pay those
every year,
every month, every year. Yeah. So that's the difference between those. The prepaids.
Yeah, prepaids. What's that?
Yeah, so that's that is all of the. So this loan that I put together has an escrow account that I talked about, paying the insurance and taxes monthly to the lender. We have to set up that impound account, so we call that prepaids. That is for the recurring costs. If you chose not to have a impound account for taxes and insurance, this would only be the amount of interest that you would have to pay to close the loan. So if we funded the loan on the 27th, they would pay in a 31-day month, they would pay interest for the 27th through the 31st. So this would be, you know, maybe $1,000, depending upon the loan amount and the rate. It would be much lower. So this is higher because we are collecting the closing costs.
You're collecting property tax and insurance up front. And then I want to talk about that prepaid interest for a second. That's another thing I think people don't often understand. So when you get a loan, your loan is always due on the first of the month, and it is due on the first of the month for the month before, right? So like if you are
for the current month,
for the current month,
the principal and interest, the principal is paying the current month.
For the current month.
Right.
Okay, so but if you close your loan on the 15th of a month, you're not going to have, like, let's say you close your loan on June 15th, your first payment's going to due August 1st. Is
Right.
that not correct?
Right.
Right. So your prepaid interest though is from June 15th to July to June 30th.
Right, because the way it works is when you make your July 1st mortgage payment, you're paying your July principal, you're paying your June interest. Interest is paid in arrears. So if we close June 15th and we don't have a payment July 1st, then how are we going to get the interest from the 15th or the 30th? We're going to have you prepay it in your closing costs.
Right, but
And
if you get a brand new loan and it closes on June 15th,
Mhm.
your first payment is due on August 1st, right?
Correct.
Right,
Right.
and so the payment is due for the month of July.
We don't have, they always, I'm sorry, this is very difficult. We don't have a principal payment until the August payment because they let the interest accrue over the month of July, and then you start paying everything on August 1st. Your principal payment will be due August 1st, and you will always pay the interest in arrears.
Oh, so you're in any one month you're paying the previous interest and the previous month's interest and the current month's principal.
Always, yes, exactly.
Oh, that's interesting. Okay,
it's a little confusing, and then people think, oh, I get when we do a refinance, they're like, oh, I'm skipping a month. You're skipping a month of principal. You will never skip a month of interest because that's how everybody makes their money, so they want the interest, right?
Okay, so that's very interesting. So let's just say we close on June 15th. You're paying prepaid interest for the month from June 15th to June 30th. So you're paying interest only, no principal. So that is called prepaid interest, and that's going to show up in your prepaids along with any prepaid property tax or prepaid homeowners insurance, right? So that's what goes to the prepaid. And then for July, you will have no payment for July. So really you'll have no payment for June except for your closing costs, no payment at all for July. And then on August 1st, your first mortgage payment is due, and that includes the interest for all of July and the principal for August.
Right. So if you are able to, well, let's say you're renting an apartment and you close June 15th and you're able to move into your new home July 1st because you've got everything all prepped and ready to go, and you already had to pay your June rent, you truly will have 1 month of no housing expense because there's nothing due in July. So you can kind of say, oh gosh, that $3,000 that we used to pay for our rent and we don't have to pay anything for our new mortgage. Wow, we get to have that $3,000. And that is when you can go buy a new couch. You cannot buy the new couch while we're doing the loan because we don't want you incurring any new debt. So you can use that money to purchase something, right?
And if you were to close on June 1st, say, you would have much more prepaid interest, but you would have no mortgage, principal payment for June or July, right? So your first you would have basically almost 2 months without a payment. Essentially, you wouldn't have to pay for June or July. You wouldn't pay until August 1st.
Right. Yeah, you will have brought the interest in for all of June, but it'll be part of the closing costs.
Yes, exactly. Be part of the closing costs, exactly.
Right.
But you will go 2 months really without having to make another payment.
Right. And another thing we can do if somebody's going to close June 1st, but doesn't want to bring in that whole month of June, we can have them sign May docs, which gives them a May note with a July 1st payment. And then they're not bringing the interest is, we don't have to collect the June interest because we know they're going to make a July payment. So they basically can come in and maybe have a little bit of credit for the interest that they're bringing in. So if we close on the 3rd, then they have to make a July payment. They're getting a little bit of a credit because they're going to make a July payment that pays the whole month of June. And so we'll credit them back 3 days of interest on their closing costs, knowing that they're going to pay all of the June interest on that payment.
Got it.
So
Okay.
that's a way to help save on closing costs if they are at a beginning of the month close of escrow, because that's just how it fell on the calendar, or that was the way to get into the home. We can have them sign the May docs, basically have no June payment, but know that they have a July payment to pay all that June interest. That's the way to alleviate bringing that to the closing table and just, yeah.
Well, that was interesting, Janice. I really appreciate having you take us through the steps of a loan. And I think that, a lot of borrowers are, very experienced with this because, a lot of people have refinanced maybe several times recently. But if you're a first-time home buyer, I'm guessing that all of this is new to you. And you probably have this conversation quite a bit with first-time home buyers, right?
Yes. Yeah, we go very deep dive with them and explain a lot, which is what my job is, because we should make sure that nobody's going through this process wondering or with questions not being answered. It's very important to me to answer all the questions. And if I can't figure it out, I'll go find somebody who knows for you. So.
Right. And there are a lot of different options, and it is highly technical. I mean, I think that we kind of got a little bit into the weeds talking about the prepaid interest thing, and that's my fault, my bad. But
no, it's good though, because that you basically opened up a door that maybe they didn't realize or didn't think to ask about, or if they should even ask about it. But that's what's good about the mortgage coach, the TCA, is that they have it on every line, right? So if they say, what is that? Then we can go through it and dive into it together. And if they know what it is, then they don't have to ask.
Right. And it also helps people understand like what closing costs are. I think closing costs are a big mystery to people as well. And then of course there's recurring and non-recurring closing costs. And a lot of times people consider that these closing costs are loan costs, like the bank is charging me this, and the bank isn't actually charging you most of that. Right. So I think it really helps to break down all of this stuff so people can really understand because you always need down payment plus closing costs. You don't need 20%. I mean, you need 20% down to have no mortgage insurance, but you need 20% plus closing costs, which
4%,
which a lot of that is not bank stuff. It's prepaid stuff that you're going to be paying anyway on an ongoing basis. And
people need to know, because sometimes they have $100,000. We'll just use a round number, but they need to understand that has to work for your closing costs and your down payment. So then we have to adjust our purchase price according to what our closing costs will be, and know that this will be your down payment.
How much cash they actually need to bring in to get this closed. So
yeah.
All right, Janice. Well, listen, thank you so much. I really appreciate you sharing all that information. I know a lot of people are going to find it to be very valuable as well. So Janice, how can people get a hold of you? Tell us again your contact info.
Get a hold of me at 408-829-0806. You can text me or call me, and my email is jsmith@guild, GUILD mortgage.net. That's a .net. So I'm available.
And you have a website too, right? Your website is?
Yeah, Janice Home Loans. Or you can look me up on Google at Janice Smith Loan Officer, and it pops up.
Okay. And how about your Twitter, your Instagram, no, just kidding. Just kidding, all that stuff.
That's so hard for me.
The best way is ironic. Just pick up a phone and call Janice, or text her. That's just the easiest way to cut through all that. So, all right, Janice.
She likes phones.
Tremendously valuable information. I really appreciate it, and we'll catch you on the flip side sometime.
Thank you so much, Seb. You have a good afternoon.
Okay. Thanks, Janice. See you later.
All right. Well, I really hope you enjoyed watching this video. I know I learned something, and I really hope that you did too. And if you enjoyed this video, if you got something out of it, you're probably going to like these videos over here. These are my most popular YouTube videos. Go ahead, check them out. And also, please don't forget to subscribe to my channel. I would really appreciate it. All right. Thank you so much for watching. I will have another video before too long. Until then, please stay tuned.